Hi, this is Rob Roy of Elliott Wave Options. In this video, I'm going to explain the core concepts of Elliott Wave theory to you. It doesn't matter if you're brand new to Elliott Wave. We're going to use lots of visualizations and examples to make sure this is the perfect way for you to get started. I know there's a lot of Elliott Wave material out there, but when I looked into it, I realized that the vast majority of it just really focuses on that 5-wave impulse pattern without really going into the concepts behind the theory itself. So in this video, I'll do just that. I'll go into more detail on the core of Elliott Wave theory to help you understand it better. It's a lengthy video with a ton of content, but I promise you, the quality is great. If you haven't got time to watch it all now, just make sure you subscribe to our channel and you can catch us later on. Before we get started, I should let you know that the information from this tutorial came from the lessons of our Elliott Wave core class on our website. Register for free and do the first module. The link is in the description. Enjoy the content. Welcome to the Elliott Wave Theory Overview. Elliott Wave Theory is a method of analyzing cycles in the stock market. It's probably the most all-encompassing, sophisticated form of technical analysis ever developed. Now, you don't have to know all the details, but we're going to cover what we feel is important to be a successful trader. It's based upon identifying patterns in the stock market to identify where the cycle may repeat. By understanding the patterns and where the market is in the current cycle, Elliott Wave theory can be used to forecast future market movements. Type of Elliott Wave price movement, motive and corrective patterns. In Elliott Wave theory, price movements are categorized relative to the larger trend, as you can see in the chart. There's the long-term trend clearly to the upside. The motive is when prices are moving in the direction of the larger trend, and the corrective moves are when the prices are moving counter or against the larger trend. So in the example again, you can see the motives are in the direction of the upward movement, the correctives are down, another motive to the upside. And that shows you that the two motives are moving in the direction of the overall trend, which is up. The corrective is moving in the opposite direction, or down in that instance. Remember, bullish and bearish markets have direction of motive and corrective movements that are opposite. In other words, when you have an upward trend, the motive moves are to the upside, but the corrective move is down. However, when you have a downtrending market, meaning that the motive moves are to the downside, the corrective move is actually to the upside. I found that quite often people get stuck with the word correction or corrective as an always downward move, but not in Elliott Wave. In Elliott Wave, corrective moves are basically just a move against the larger trend. Motive waves, moving with the larger trend. On the screen here you can see the impulse move, which is one of the motive patterns, and that's the traditional 5-wave pattern that most people see. It's also the one that's most talked about. But there's also a bit more of a complex pattern known as a diagonal, and you can see it's kind of like that pennant formation, and there's a lot going on. And we're going to get into more detail on what's happening with these waves within the waves a little bit later on in the presentation. Corrective waves, moving against the larger trend. There are three primary corrective patterns. There's a zigzag, a flat, and a triangle. The zigzag is a 3-wave directional pattern, as you can see, the A, B, and C. The flat is also a 3-wave pattern, but basically it's a sideways or non-directional pattern with support and resistance levels, but you're kind of just moving in a sideways manner. The triangle is a breakout formation, consolidation. So the move is consolidating from a larger area down to a smaller point, yielding the potential breakout from the triangle. But all three are known as corrective patterns. Basic cycle structure, an idealized 8-wave structure. The combination of a motive wave and a corrective wave is the general structure of the complete Elliott Wave cycle. So here we have the motive move to the upside, followed by a corrective move to the downside. And in this example, the motive move is that traditional 5-wave impulse pattern that's shown so often, and the corrective pattern is a 3-wave zigzag, which is also shown quite often. Elliott noticed that the market repeated this 5-3 structure again and again, and this became the foundation of his theory. Understanding degrees, waves within waves. The term degrees relates to the fractal nature of Elliott wave patterns, which means if you take any single part of a pattern and zoom in on it, you'll find that a pattern can also exist at a lower level or lower degree. Let's take a simple pattern. This is a common 5-wave impulse pattern. Let's assume that the time it took to occur was 1 year. So from what will be labeled as a 0 point to the end of the wave 5 is a year in time. So within those waves, lots of things could be going on. Perhaps there's a 5-wave impulse pattern within the wave 1, a 3-wave corrective pattern in the 2, another 5-wave pattern in the wave 3, a little bit longer, taking more time, a little stronger wave 3, another corrective zigzag in the wave 4, and then finishing off with another wave 5 pattern to the upside within the wave 5. So waves within waves, patterns within patterns. Now these patterns are described as being of different degrees. The larger pattern that took a whole year would be a primary degree impulse pattern, while the last leg of that pattern that took only weeks to months would be an intermediate degree impulse pattern. This concept of degrees is one of the reasons why people can be confused about Elliott wave counts. People can be focused on different degrees and therefore disagree about the current wave count. Elliott actually categorized the degrees of wave patterns, starting with the biggest, a grand supercycle, which can take centuries to form. Then there's a cycle, which takes decades, multiple decades, 40 to 70 years. Cycle, which is one probably talked about the most often, 1 to several years. A primary, which can be a few months to years in the making. Intermediate, which takes weeks to months. A minor pattern, which is weeks. Minute, which is days. Minuet, down to hours. And subminuet, which is minutes. If you've heard me talk about Elliott wave at all in the past, I've talked about the fact that the patterns work in any time frame. And this category of degrees shows that. You just break it down smaller and smaller and smaller. Waves within waves, patterns within patterns. You can go all the way down to, and I have a 3-minute futures chart on all the time. And you consistently see the same Elliott wave patterns that we're looking at and sending alerts out on a daily chart. Mono versus complex waves, how the waves subdivide. Mono waves move from their starting point, which is denoted by 0, mentioned that earlier, directly to the end point. And I really like to see it when it moves in kind of a 45-degree angle, as illustrated here on your screen. A complex wave contains waves of a lesser degree and therefore doesn't necessarily move directly. In this case, you can see there's a zigzag pattern, corrective zigzag, where you had a move, a counter move or corrective move, and then another move in the direction from 0 to 1. So the zigzag within that move from 0 to 1 makes it a complex wave. Elliott wave and Fibonacci, the golden interval, quite often termed the golden ratio. First of all, we're going to talk about the mathematics of Fibonacci. Then we'll discuss just how common mathematics is in the natural world and why it is therefore relevant to the financial markets. In the Fibonacci sequence, we talk about something discovered by Fibonacci, who was a 13th century Italian mathematician. So we're going way back in time. But Elliott was fascinated with this mathematics from Fibonacci. Fibonacci observed a series or sequence of numbers, which is a continuous sum of the previous two values. So we start with 0, then go to 1, 1, 2, 3, 5, 8, etc. So as it moves on out, we'll talk about the fact that this summation series is adding the previous two numbers to give you the next. 0 and 1 is 1, 1 and 1 is 2, 1 and 2 is 3, etc. And that continues all the way up to infinity, basically. Fibonacci discovered that the sequence of numbers is uniquely characterized by the consistent ratios that occur between each number in the series and the numbers that follow it. If you look at this chart here, you see a great illustration of that. So over in the left-hand column, the vertical side, looking down, you see the 0, 1, 1, 2, 3, 5, 8, 13, etc. The same summation series that we just showed you on the previous slide. Now over to the right, you see the ratio of that number to the number ahead. So 1 is 100% of 1. 1 is 50% of 2. So this percentage is the number to its left, that percentage of the next number in this vertical line on the left-hand column. Then on the third column over, you see the ratio to two numbers ahead. So 50%, 33, 40, etc. And then over in the right-hand column, you see the ratio to the number to three numbers ahead. What's fascinating is if you look in the first-hand column, you start to see pretty quickly that we're right around that 61.8% ratio, and when we get down to 89, it is 61.8, and it's there for the rest of the way up the series. In the third column, the ratio to two numbers ahead, we're pretty close to the 38.2% fib level, which we also hit at 89, and you can see moving forward from there, regardless of the numbers in the summation series, the ratio to the two numbers ahead is 38.2. And then over in the far column, 23.6 is the number we're getting close to. And again, once we hit 89, we're right there at the 23.61 exactly, all the way up, continuing in the series. So it's quite intriguing that these kind of mathematical ratios exist. But what is the relevance to our discussion? Well, the fact of the matter is that these ratios can be observed consistently throughout the natural world in all kinds of scenarios relating to people, plants, weather, etc. Now, as it says on the slide, the Fibonacci sequence always attracts people's attention because it's fascinating just how deeply the pattern repeats in nature. We see it in human anatomy, plant anatomy, and as it says here, breeding patterns. Fibonacci, the mathematician, famously studied the mathematics of rabbit breeding patterns, among other things. I have a real-life example of the one here that says human anatomy, where you see the picture of a hand. My son was in a bad car accident. I'll save you the gory details, but basically the bones of his hand were splintered like bamboo. And when we were talking with the orthopedic surgeon, he literally, over his x-ray, put this exact same picture here. Note what those numbers are, moving from right to left, 2, 3, 5, 8, where, again, the summation series, 2 and 3 is 5, 3 and 5 is 8. And he showed this, and basically what he was talking about is the relationship of the tip of the finger to the first knuckle to the second knuckle to the primary ones, the third that we talk about so often when we make a fist. And then he kind of mentioned a little bit about the summation series, and I said, are you talking about Fibonacci ratios? And he goes, you know Fibonacci ratios? And I said, yeah. And we started talking, and meanwhile, my son's sitting over there. He's like, excuse me? I'm still here, because he was sitting there in quite a lot of pain while we were having a Fibonacci discussion. But basically, the orthopedic surgeon used these exact ratios to know where to put the pens and the plates in his hand to rebuild the bone structure in his hand. It's fascinating. Looking at plant anatomy, you can see in this example of a plant, and basically it works with a tree as well, where you have the overall plant or tree, and then each branch is just a degree, if you will, of the larger pattern overall. And in the right-hand column, you can see where we have the Fibonacci number sequence here of the number of branches from the overall trunk, the beginning of the plant or tree. It's truly fascinating when you start looking at it. Fibonacci ratios are also notably plotted as a spiral that manifests throughout the natural world. Look at the depiction of this spiral. You can see that we have these squares that are the Fibonacci numbers, 5 and 5, 8 by 8, 13 by 13, 21 by 21. And when you put those squares together to form the larger rectangle, and then take a line and connect the corners of those squares, you get the Fibonacci spiral, which shows up all over the place in nature and science. The storm systems. Live in Florida. We're so used to seeing that swirl with the hurricanes that visit us quite often. Probably the most commonly talked about illustration of the Fibonacci spiral is in the Nautilus shell. but it also exists in plane geometry. If you just spend enough time to stop and stare at a plant, you can see the patterns. Now at this point you might be thinking, well, this is all very interesting, but what has it got to do with trading? Well, let's summarize it succinctly. Given that Fibonacci number series is so prevalent in the behaviors of the natural world, many people believe that it is not unreasonable that we should also see this number in the way the human world behaves. And one of the ways that we can measure human behavior is the buying and selling in the stock market. Our emotions of hope, greed, fear, and pain drive all the decisions we make around buying and selling. When we plot this buying and selling as stock price charts, we can often observe Fibonacci ratios in the prices. One thing to be aware of when it comes to Fibonacci, though, is the topic can quickly become sidetracked into a discussion about esoterica. Whether you believe that there's some sort of a mathematical order to the universe, or whether you think people see what they want to see and the phenomenon basically just becomes self-fulfilling, that would be discussion for another time. We could literally spend an entire series on Fibonacci. The important takeaway for this class is that Fibonacci numbers and ratios are commonly observed in many places, including and especially in the financial markets, which is why Elliott himself became so enamored with them. Therefore, be aware and watch for them. When using Fibonacci with Elliott Wave, typically the following ratios are considered to be the most important. Note that the 23.6% one is not there, 23.61% specifically. That's because Elliott found that not to be as strong of a point of support and resistance within the Elliott Wave patterns. That's what we're going to be using these Fibonacci ratios for. Support and resistance guidelines, price targets, if you will, or estimations of where the 3, the 5, etc. may wind up. But with the 23.61%, it just didn't feel like that was strong enough for it to actually count as a support resistance level or a corrective move to be put in one of the corrective patterns. That's why it's not on the list. Applied Fibonacci examples. Let's now look at some examples of how Fibonacci relates to the price levels within Elliott Wave patterns. In particular, we'll be focusing on the concept of retracement and extension. Remember that these are only examples, and each pattern has its own rules that we'll review in later sections. Fibonacci ratios used as retracement levels. In this example, we see how the range of 1 to 3 can be used to set a price range for the expected pullback in wave 4. So looking at the example here, you see from the beginning of 1 up to 3. So again, from 0 to 3. We'll talk about that a lot in the world of Fibonacci. The move from the beginning of the motive or impulse, depending on which it is, from 0 to 3. And then you look at those Fibonacci ratios for the potential wave 4 retracement. Here, note that the stock came down and hit that 38.2% level several times, again illustrating the power of Fibonacci ratios for support and resistance levels. Ultimately, the stock retraced to 44%, which is squarely in the range expected between the Fibonacci ratios of 38.2% and 61.8%. So in this case, we are using Fibonacci to identify targets we expect the market to retrace to. In this example, we see how the range beginning from 1 to 3 can be used to project the target for 5. So again, starting at the 0 point, the beginning of wave 1 through 3, you look at 61.8%. Start from there, where the wave 4 ends, and the 61.8% target gives you the expectation of where the wave 5 can go. So in this example, the move from 4 to 5 is moving 61.8% of the move from the 0 point to the top of the wave 3. This is how we use Fibonacci ratios to project extension levels as price targets for stocks. Elliott Wave in time, the duration of patterns. Elliott Wave theory also provides targets for time frames over which the formation of various patterns or waves should elapse. This is typically expressed as the length of a wave measured in time relative to the time taken for another wave to occur. There are different time-based rules or guidelines for each pattern. These are typically less focused on, but important to be aware of. I use these as, based on the conversation there of rules versus guidelines, as general guidelines. I haven't found personally for them to be focused or accurate enough, I guess I should say, to be considered pure rules, but I do think they're helpful in using them as guidelines on when to set up a trade, especially in the world of trading options where time matters. You can use them as guidelines to figure out how far out in time to go to select your option months. Let's now look at a simple example of how time relates to Elliott Wave patterns. Remember, this is only an example to help you understand the concept, and each pattern has its own rules. A list of the rules is included as a resource elsewhere in this course. In this example, you can see that for impulse patterns, wave 4 is not allowed to be more than twice the time taken for wave 3. So in this instance, this is actually a rule. So you can see the move from 2 to 3 there. So that's 100%. That's the move. You double that, and you can see in this case, wave 4 did form in less than twice the time that it took to go from wave 3, from the 2 to the 3. So that gives you an understanding how the time rules typically work for Elliott Wave patterns. Elliott Wave rules and guidelines, defining waves and patterns. So, to help you understand the Elliott Wave rules or guidelines, we've broken them down into categories. You may not find anyone else who talks about them like this, but I think it's useful to help you understand the patterns in general. We're not going to speak about specific rules here. We'll do that in the following sections as we break down each pattern and its specific rules in detail. Each Elliott Wave pattern has rules and guidelines defining how it should be identified and labeled. Rules are strict conditions that cannot be relaxed or ignored. If a pattern breaks one of its rules, it is invalid and must be reanalyzed for a different valid pattern. I think this is extremely important when it comes to Elliott Wave, and one of the greatest benefits that Elliott Wave has, that you can be trading a current pattern and a rule is violated, so that pattern becomes invalid, but immediately Elliott Wave, the mathematical algorithm, looks to seek out, okay, if that pattern's invalid because a rule was broken, then what is the pattern? And so it immediately adjusts to give you the new pattern. And I think adjustments are an extremely important part of being a successful trader. Nobody is right all the time. No trading system is right all the time. Elliott Wave is not right all the time. But in my experience, it is by far the fastest to, when things aren't going maybe exactly as planned, to adjust. And based on Elliott rules, which is interesting, if you have a failed pattern or one becomes invalid, the new pattern that appears actually has a higher percentage chance of occurring. Guidelines are conditions commonly seen in patterns. They are not hard, fast requirements. Guidelines are very helpful in determining the optimal count when there are multiple counts that could be correct. So there are times when, okay, it could be doing this or it could be doing that. I think this slide here is extremely important because this is where a lot of the criticism comes from people that don't fully understand Elliott Wave. And when a pattern relabels or whatever, they immediately jump to the conclusion, oh, see, Elliott Wave doesn't work. No, this is what the greatest benefit of Elliott Wave is that it immediately changes if there is a pattern that's not working. Categorizing the rules and guidelines. Under general category, we're describing high-level characteristics of the pattern, including segmentation and labeling. Price provides specific price relationships and relative measurements of the segments within the pattern. The channel explains how to draw trend lines defining the pattern and how segments within the pattern should relate to the trend lines. The degree describes how the pattern interacts with patterns of the next higher or lower degree. Gross price describes price relationships of segments, taking account of price movements of lower degrees within the segments. And time describe the relationship and measurements in time between various segments within the pattern. Welcome to this section on the impulse pattern, the most common 5-wave sequence. The impulse pattern is a 5-wave sequence, and as diagrammed on the left-hand side, is the most common Elliott wave pattern. It's what you normally see illustrated when someone is talking about Elliott wave. As you'll learn throughout this course, Elliott wave goes far deeper than just this 5-wave pattern, but if this was all it did, it would still be extraordinarily helpful in the world of trading directionally. The 5-wave impulse pattern moves in the direction of the larger trend and is labeled with the 1, 2, 3, 4, and 5, again what you're used to seeing. But those waves subdivide into 5, 3, 5, 3, and 5 waves as well. The impulse pattern can be bullish or bearish. Remember what we talked about on the previous slide. We're moving in the direction of a larger trend. So in the case of a bullish impulse pattern, we're moving to the upside. In the case of a bearish impulse pattern, we're simply moving to the downside with the same rules and guidelines that apply to the 5 waves, applying to both patterns, whether it be to the upside or the downside. The diagonal pattern, Elliott's directional triangle formation. As you can see from the graphic, the diagonal pattern is a 5-wave sequence. It moves within the channel lines that are drawn from 1 through 3 and 2 through 4. It's labeled as a 1, 2, 3, 4, and 5. It can be expanding or contracting. It can be either leading or ending. We'll go through each of these bullet points in more detail as we go through the course, but something I'd like you to note at this point in time is although the patterns look similar, there are some distinct differences with a diagonal pattern. In noting the differences between an impulse pattern and a diagonal, diagonals don't have monowaves. You may have noted from the previous slide that we showed that the wave 1, 2, 3, 4, and 5 are all drawn with jagged lines. The internal waves are shown as zigzags to denote that they must be complex. As with impulse patterns, diagonals can be bullish or bearish. Here's the same type of pattern drawn to the bearish side. It's still the 1, 2, 3, 4, and 5, but again, each of the waves is complex on the way down, just the same way it is on the way up. To this section on the flat pattern, a sideways corrective pattern. Although this is not necessarily my favorite Elliott wave pattern to trade, it's really important to understand how a flat works because it's part of the whole Elliott wave trading system, and you have connective patterns that may be between two directional moves. So the flat pattern is a 3-wave sequence, so ABC. The flat pattern generally moves sideways. Common Elliott wave pattern can be regular, irregular, or running. We're going to go through that in more detail. And so that goes to the actual structure of the ABC, because what's on your screen now is basically showing all of the waves or segments at the same length, but it doesn't have to be all in the same length. Labeling with that ABC, as is common with a flat or a zigzag in the corrective world of Elliott wave. And it subdivides into 3, 3, 5. Flats can be bullish or bearish. Well, boy, that sounds counterintuitive, doesn't it? Because we just got done talking about how a flat is, in general terms, a sideways pattern. So how can it be bullish or bearish? Well, that's what I was explaining just a minute ago, as well as how does the flat maybe act as a connector between two directional patterns? Which way is the A wave? If the A wave is to the upside, and then you have your corrective B, and then your extended C, then it's considered a bullish flat. If the A wave is to the downside, and then you have a corrective upward B, followed by a downward C, that's actually considered a bearish flat. So again, the terminology can be maybe confusing at first blush, but then when you understand we're really focusing on what's the direction of the impulse A in the overall flat pattern, that's where the distinction of bullish or bearish comes from. So let's talk about the different types of flat patterns. The regular, we talked about this just in the slide a minute ago, that's the one that most people refer to as a flat, where it's just a general sideways pattern with the A, B, and C segments all being virtually the same length. as far as the price movement. An irregular pattern is also sometimes referred to as expanded. Note that we have the B wave longer than the A wave and the C wave also longer than the A wave. But the important thing that I want you to realize here is the terms irregular and expanded are actually interchangeable. And then we have a running flat where we have the A moving to the upside, we have a larger B, so the B wave is larger than the A wave as far as price is concerned, but then the C wave stops short of the A. So when we're realizing that flats are basically, in my viewpoint, connective patterns between two likely directional moves, it is important to understand what flat do we have. Is it a regular, irregular, or expanded, or a running flat? The zigzag pattern, the most common three-wave sequence, and also by far my most favorite Elliott wave pattern of all. The zigzag pattern looks like this. Obviously, it's a three-wave sequence. It typically moves against the direction of the larger trend. As we said just in the intro, it's the most common corrective pattern, and that's an important distinction to make. Technically, a zigzag is a corrective pattern. That's why we said it typically moves against the direction of the larger trend. I just wanted to set that distinction in the previous comment, labeled as ABC. So there's your ABC labeling, and it subdivides into 5, 3, 5. As with the majority of Elliott wave directional patterns, zigzags can be bullish or bearish as well. So there's an example to the upside, the labeling of A, B, C, as we just talked about. Remember how the subdivisions work. And to the bearish side, I wanted to talk about this for a second. You'll notice that when we see market downturns, our trade alerts tend to focus quite often on a bearish zigzag rather than a full-fledged 5-wave impulse pattern to the downside, for a couple primary reasons. We all know the market moves down faster than it moves to the upside. And in addition, you may or may not know this, that when a downward pattern completes, the rebound or the corrective move back to the upside can happen rather rapidly. So the longer you're exposed to the downside, i.e. a 5-wave impulse pattern, the more chance the market has to go against you and maybe take away some of your gains. So you'll notice that when we send out our alerts in market downturns, they're quite often tied to bearish zigzags rather than impulse patterns. The triangle pattern, consolidating the trend. As you see from the graphic on the left-hand side, the triangle is a common 5-wave corrective sequence. So remember, it's one of the corrective patterns that includes flats, zigzags, and triangles. Generally moves sideways or consolidates, and you can see that pattern is something that you're probably starting to get used to. Talk more about that in a second. It moves within the channel, so you have a set of two lines there that connect the highs and the lows. It can be contracting or expanding. The vast majority of the time we're going to be talking about contracting triangles. Expanding triangles do exist, but they're really rare, so we'll cover them, but just briefly. The labeling is done as A, B, C, D, and E. As you know, in a zigzag pattern is a corrective pattern as well as a flat, they're labeled A, B, C. So we have a difference here in the triangle, labeling it A, B, C, D, and E. It subdivides, or the corrective waves, into 3, 3, 3, 3, 3. In other words, you're not likely to find a 5-wave subdivision in any of the segments, A, B, C, D, or E. Triangles can be bullish or bearish. And in general terms, you might say, it doesn't really make much sense. Look at the two patterns. Basically, you would say, well, the bullish pattern breaks to the upside and the bearish pattern breaks to the downside. But look a little closer. Let's look at the graph on the left-hand side. You can see the dotted line that shows the entry into the triangle. So both of them are showing a set of lower highs and higher lows, but the entry matters. So the entry on the left-hand side is coming from lower to higher up to the upper trend line. Then you go into the subdivisions on the A, B, C, D, and E. In the graphic on the right, the bearish triangle, you can see that the dotted line shows that the entry into the mouth, or the widest part of the triangle, is to the downside. There are different types of corrective triangles. The first one is the symmetrical. That's what we've shown on the previous couple of slides, where you have a series of lower highs and higher lows. So the mouth of the wedge is out to the left, and as you move into the point of the wedge, each of those segments gets smaller and smaller in price movement. There's also an ascending triangle. In an ascending triangle, the highs are very similar. So you can note that that upper trend line here is pretty horizontal. And then we have the lower highs that we move up towards the point in that triangle. If we have ascending triangles, we're going to have descending triangles as well. In this case, the lower trend line is the one that's horizontal, indicating that the lows are similar. And then we have a set of lower highs as the upper trend line moves down towards that lower trend line to form the point just before the breakout occurs. Here's that expanding triangle that I mentioned. It's pretty rare. You see, it's the exact opposite direction. Now the point is over on the left-hand side of the triangle, and the mouth of the triangle is actually on the right-hand side. For more lessons like this one, and weekly Elliott Wave trade ideas, enroll in Trade Finder. The subscription is free, and you'll receive access to the Elliott Wave core class, plus regular live webinars with me. Sign up now. Take care, everybody.